All right, guys, we are here live. 24 of you guys with us, 26. It's numbers going up. All right, Jerome Powell, Fed chair, rates are the same, supposedly. This is where we're at. Is anybody surprised? No. But the orange man said, well, I heard September we're getting rate cuts. So do we have to wait till September? That's what it sounds like. And here comes the man himself.
Good afternoon.
A lot of people just made money.
Remain squarely focused.
A lot of people just made money on poly market because they said good afternoon.
Of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments.
All right, I'm going to, throughout this, just pause briefly and talk for a second. But Jerome Powell, man, no one wanted you to make this decision. Everyone was urging you to cut the rates. That's not what we're seeing here. Going to have to wait till September, supposedly. Jerome might be canned by then.
Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year.
Now it's at a 3%. Everyone, economists, thought it was going to be less than that because the economists are all bought and paid for and stupid, and they look at tricks. That's why they're always wrong.
Down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting
Jerome.
A one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions communities, families, businesses across the country, everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration.
Is that Robert California from The Office? Bruh.
For a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit of 2, as I mentioned, even excluding tariff effects. Labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to almost the whole committee that the economy is not performing as though restrictive holding it back inappropriately. Downside risk to the labor market.
All right, I'm going to pause there real quick. He keeps saying modestly restrictive market. I don't think that President Trump would agree with that. I don't think that a lot of people would agree with that because there is so much positive. There are so many positive things that you can point to. The GDP that just came out this morning that was expected to be 2.2, 2.3%. It's 3%. All right. All these different metrics that are making these individuals cautious are not even the actual metrics. They're slightly better in almost every regard. And everyone thought tariffs would ruin the entire economy. Bill Maher just the other day on his podcast said it. Well, I thought he was going to really ruin things. Well, it turns out that's not what happened. Of course not.
In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September.
But here's the thing for me, like, and I've been a little critical on Jerome in the past. If you're saying right now unemployment's fine, and right now inflation is not exactly where we want to be at, but it's pretty damn good, then what are you waiting for? Why do you need 2 more months of a couple more data pieces that might be slightly lower than it is now to make the decision, Jerome? I don't get it.
We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still, a ways away from seeing where things settle down. We are clearly getting more and more information. And, I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge.
It is for you to judge. You're the Federal freaking Reserve. You're in charge of who does these and makes these decisions. That makes no sense. And let me point out something, a little bit of a history for the listeners right now. Jerome Powell in the past has made remarks giving investors, the entire world, everyone listening like we're doing right now. He said, basically, I'm going to do one thing. We're going to do this. We're going to keep the rates the same. I forget exactly what it was in the past, what he did, but then unexpectedly, he did the exact opposite thing that he told people he was going to do. So at the end of the day, is Jerome even trustable at this point? We have so much evidence for this man to clearly be, okay, I think it's not insane for me to lower rates right now. Again, guys, it's not just the S&P, the stock market, the crypto guys who want this. It's real estate guys. It's the president himself who asked him last week in person, jokingly, jovially, slapped him on the back. Well, I just want him to lower the rates. Jerome Powell. And he's not doing it. The orange man's not going to get you to do it, Jerome. Who's in this guy's pocket? Who's in this guy's mind? Someone is telling this guy, don't listen to the president. And this is why it's really starting to bother me at this point. Because months ago, if you were to criticize Donald Trump's economic plan, sure, there's a lot you could have criticized. But now it's months later and everything has smoothly worked. And we are now in a position for this man to actually lower rates, and he's still not doing it. That's where it bothers me. I'll be vocal about that. Your job, first of all, history, talked about this last week and the week before on the live. The Federal Reserve is not somebody that we vote for. No one voted for Jerome Powell. The Federal Reserve is a private institution. And in my opinion, they shouldn't even be here in the first place. It's like central banks. This isn't smart money. This isn't sound money. This isn't Austrian economics when you get to print money out of thin air and run a fractional reserved banking system. This is exactly why crypto exists. This is exactly why you guys are probably on the stream with me right now, because we don't want guys like this who we didn't vote for to dictate what our markets are going to look like. It's very bothersome. And what bothers me the most is your job is to get behind the administration at the time. And when you don't give a crap about what the administration is telling you to do when it's working, then you got to go. I'm sorry.
But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning, we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly.
All right, but that's again where I don't agree with him fully, because last year, if you're like, why are you looking at last year's stuff? You should be looking at the future. Last year's data and metrics was when the Biden administration was here. You want to talk about job growth and all this stuff remaining the same? Oh, we don't know what the future. Donald Trump is signing deal after deal after deal after deal for infrastructure, automobile companies, AI companies, like chips, like all this stuff. Not chips, but like all these things potentially. Warehouses, big job creations are coming all over the country, right? Like we have automobile manufacturers, so many different technology companies are deciding to set up shop in the United States and open massive warehouses, do everything that they have to do in the US. That's going to create a lot of jobs. So yeah, maybe not right now in June or July, whatever the hell month we're in July, almost August, but 6 months from now, a year from now, not last year, things could look much better, Jerome. So what your decision is now could impact 6 months and a year from now. It's not going to impact last year. Come on, brother.
Roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report you get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for quarter point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation is a bit above target, maximum employment is at target, that calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking. And we certainly had that today, I think all around the table.
I really like that question she asked, to be honest. But again, I just keep circling back to the same thing here. And this is my take. You guys can lend your own opinions. And I hope someone asked this question. But when the president is putting forth a clear plan with Howard Lutnick, Scott Bessent, Paul Atkins, all of these guys that are in his administration around him with the same goal, pushing the goal forward every day and achieving everything they're looking to achieve, everything is right on track. If you are the one cog in the wheel that's not on board, that is tripping up the rest of the plans, while all of them are asking you to get on board, just do one simple thing, which was the last meeting or this meeting now, just lower the rates, and you're still not doing it. That bothers me. Like if you're going to look at a very powerful president who says he wants to accomplish something, he's doing exactly that. And he says, hey, in order for this to keep going, I need you to get on board with me. And you say, no, like some mad little, no, I'm not going to do it, like Jerome. But you're an adult, sir. What are we doing here?
In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says. And that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy. And so others may say it's more restrictive or less restrictive even. We're going to be, at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing
It's a very Wall Street Journal type question.
now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, substantially higher than
Biggest ever.
than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price.
We are doing so well with tariff revenue income that Donald Trump and Howard Lutnick want to propose giving Americans money. How else would we be able to do that unless you printed it like they did during COVID and we all got stimmies? This is not from printing. This is from revenue. Much different.
And companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer. But, the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast.
Also, a company, when he talked about American companies having to eat the cost of tariffs, most of the time, maybe not most, but that's not even true in large part for every single scenario. A company like Walmart is going to tell wherever they get their stuff from, you're eating that cost. I'm not eating that cost. So we're paying the same cost here in the States. That's one example.
We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think, I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish.
If there won't in the end be a big inflationary problem, and you're saying jobs are fine and the inflation's fine, then what are you waiting for?
That in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say, when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president.
Sorry, I don't want to stop there in the middle of a question. I don't agree with that either. If more money in the back in people's pockets because of tax cuts, income tax, whatever it may be, means a couple $100. If you get rid of income tax, like after a year, that's going to add up. That's pretty significant. You're saying that's going to have no effect? We saw an insane amount of effect go into the marketplace and the economy when people were handed stimulus checks, $1,200, whatever it was. So one time, $1,200, massive push into the economy. You don't think a year of no income tax and other tax cuts is not going to reverberate into the economy in a positive way? How?
So let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
That's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the.
It's been an amazing.
Oh, we don't like
ride
this.
in the
Come on, son. We don't have time for this. Let's get back to it.
And value and
variables Congress has given us, use the tools they've given us to achieve those goals. And that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that. And it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guido with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him.
What an
It's not
honor.
something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive.
That for sure makes sense. I used to do business in DC, in the state of Maryland. There's a lot of red tape when it comes to some of these old historic buildings. That's commonplace anywhere throughout the world, specific to different regions.
We started out to do the work, and we're very well along on that work. And I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation, sometimes early in the year, and then inflation turns lower. And a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the
Trueflation last month, the month before had it 1.9 and lower.
Catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through.
I also want to say this for people who don't know this: the Biden administration continuously, to change the number of inflation, left certain goods out and included some. This is a tactic that administrations use to make a number seem different than it actually is. With this administration, however, it seems like things are much more sticky and closer to that actual number. I would argue anybody to look at the trueflation number, not whatever the hell the White House or the left or Wall Street Journal is telling you.
In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed.
And let me say this as well. Milton Friedman, decades ago, was probably the number one person to say this first, but it's 100% true. If you want to zoom out, sure. Microinflation, tariffs did cause some short term. But when it comes to actual microinflation, what causes actual inflation year over year, decade over decade, it's the printing of goddamn money. And that's what the Federal Reserve does. They print money. So whatever's going on right now, it doesn't even matter. People were freaking out over tariffs 6 months ago. And I remember tweeting about it. No one's going to be talking about tariffs at all 6 months later. And barely anyone's talking about it. Trueflation's down. No one cares. It had no negative impacts, basically. Short-lived. But again, the true inflation, if we're going to be on this topic of inflation right now, stems from the printing of money. It stems from DC. And when you have a cryptocurrency like Bitcoin that has 21 million coins, you can't inflate that. So again, guys, I appreciate all 276 of you from X tapping in right now, because that's why we're all here. We want to create a new system that's better for us, a better money system that works better for us.
If you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. that's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think repeatedly forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned.
Right. So let's back up. When were delinquencies a problem? Under the last administration, for 4 years, credit card delinquencies were at all-time highs. Auto loans, delinquencies, people not paying their car loans, all-time highs. People's savings accounts, lowest in decades. People did not have money to spend. Things were so bad. And guess what? Things are much better. You're saying it yourself, Jerome. What made this difference so much better is the Orange Man. And I'm not trying to be biased. I wasn't even the biggest fan of him. But we're looking at reality right now. We're looking at different numbers to lower the rates. You're talking about a lot of stuff from last year that has nothing to do with what's been going on the past 6 months or so. That bothers me.
High-end delinquencies, I don't know what to make of that. I read the same thing, but so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate.
So lower the rates for them then,
but it's true, and it was again right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting. Some of that can be can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this dissent, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, which it may be even low, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance. Oddly enough, you've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor forces is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits. Look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision.
Oh, I thought she said Gensler. I was about to say, is that Gary's wife?
The two dissents. Was there talk during the meeting? I know you're not going to talk about what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go around where people talk about the economy, and then that's yesterday. And then today we have a monetary policy all the way around the table. Everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is. So that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that.
All right, I'm going to take a pause here. I want to share my screen on something else and just put something up that I was just kind of talking to you guys about. All right, bear with me for a second here. Because now I got everything all messed around. Where? All right, I mentioned trueflation. I just want to show you guys this. This isn't insane, all right? We're not looking at insane dramatic things, but briefly, during the past 6 months, we have been. All right, let's go back a year. We were all the way up at 3% inflation. And mind you, this is during a time where the previous administration was trying their hardest to look very good in the voters' eyes. All right, immediately, look at the drop off immediately since January. We got as low as 1.3. We actually went as lower than that. Looks like. All right, so we're down 2.4 right now. All right, that's where we're at with trueflation, the trueflation index. But you're saying you want to see more in order to lower the rates? What more do you need, Jerome? Look at the dramatic difference in the past. Basically, he stabilized things. Bro, there was a push to actually stabilize things. For 3 years plus, you had god-awfulness. Oh, come on, son. But the inactivity of these things, I think, is actually causing more instability, because the smartest people in every single one of these spaces are saying, no, this is actually why it would be very beneficial. I've seen countless individuals in the tech space, guys like Grant Cardone in the real estate space. They know the impact that lowering the rates is going to have. It's going to be a positive impact. That's just my 2 cents. I don't want to listen to Jerome forever. So right now, I'm going to play this clip of Donald Trump. I said it in the beginning of the stream. Trump said he believes Jerome will lower the rates by September. That sentiment was also just shared during this live stream, during the FOMC meeting. People were also sharing that. But this is today. Let's just listen to what Trump has to say.
Each point that this gentleman keeps up costs us $365 billion a year. Think of that. 1 point, $365 billion. If you bring it down a point, we save 365. We should be the lowest interest rate, and we're not. We're 38, number 38, because of the Fed. It's all because of the Fed. He's done a bad job. Now he's got a meeting today, but I call him too late. He's always too late. Even if he does it today, probably won't. I hear they're going to do it in September, not today. For what reason? Nobody knows. But Europe, as you know, cut their rates 11 times in the last short period of time. But the good news is we're doing better than anybody anywhere in the world. Nobody's doing anything even close to us, even with the higher rates. Each point.
Yeah. I mean, I agree with him. I have to tend to agree with Donald Trump. And again, guys, I'm not a Republican or anything. I'm not a biased person. I'm just a crypto guy. And I just want to see everyone do well here. And I think realistically and rationally, a lowering of the rates would be beneficial. So I do agree with Donald on this. And again, I think he's put forth the effort the past 6 months to convince everybody around him, including me. Like, it's time. Let's go. What are we waiting for? We're only going to see a continuation. Just this week, last week alone, we saw Trump garner more deals for us. They pushed a pause back with China while getting other deals. So there's just so much bullishness. The GDP is going to continue to grow, especially when the AI infrastructure is all set up. We might see job loss because of that, but then always with innovation like that, we see job growth afterwards. So that might be a pretty tumultuous period, but this is where we're at, guys. All right. I don't want to sit on this all day. Pause. This guy kind of looks like, what was that comedian? Oh my God, I can't think of his name right now. Bert Kreischer, Joe Rogan, the other guy, Andrew. Wow. Someone let me know in the comments. Chat, he's a great comedian. I can't think of him right now. Him and his wife, Your Mom's House podcast, Christina. What is wrong with me? I can't think of his name. Kind of looks like him, though. Also kind of looks like an egg, his head. But yeah, Donald Trump, I definitely agree with. Chat, let me know how you guys think in the comments. What do you guys feel about this? Jerome Powell. I'm not surprised the rates are not lowered. I don't think anybody is. Trump even said in this clip I just showed, he probably won't do it. And this was like an hour ago he just said this. So I guess what we have to do now, ladies and gentlemen, is you have to stick around with us here at the Coin Zone. You got to subscribe to us because we're going to go live in 2 months in September. We'll see what Jerome's decision will be then. But until then, I'm just asking you guys to stick with us because I'm going live every single day. All 292 of you, if you didn't know that, I'm letting you know now. I go live every single day. So if you enjoyed this, you'll enjoy tomorrow's and the next day's. We also have educational videos coming for you guys all the time. You're going to like those. This is the Coin Zone. My name is Crypto with Paul. I'll probably go live one more time today. So stick around. Rates are not lowered. They're remaining the same. Jerome Powell's pooping the bed. People are upset. Got to wait till September. That's about it. See you guys again here soon.